Chris, thanks for being with us today.
Hey, thanks for having me.
Let's start with your giving us a brief overview of your background in Chatham Harbor.
Yeah, sure. So early in my career, I worked on a small cap trading desk for a few years, and then after that, I started my own funds. Our fund specializes in small caps for the most part. We look at misunderstood value names. So we look for companies that trade at low multiples, but still have some kind of growth aspect to them.
Chris, tell us about your investment philosophy.
First of all, we focus on companies that are trading at less than our 3 times our version of pre-tax earnings. That's sort of hard to find right now. So it's more or less a lot of the companies we look at are hidden for some reason. The companies could be a situation called the good go bad go, where there is a legacy business that is declining and another portion of the business that's really growing. And if you look out 2 to 3 years or 4 years, you have a business that is completely different optically than it looks like today. So you have a company that is getting valued on the previous business, but in reality, in a few years, it's going to be a whole different story. We also look at small companies that are more or less growth names that may not be profitable yet, and we try to look out 2, 3, 4 years. We try not to go more than 4 years, and try to figure out what the economics and the unit economics of the business are going to look like, and what margins can be. What revenues can be in that 2, 3, 4 year period, and we try to buy that at less than 3 times our version of earnings.
Why specialize in small caps?
Why do we focus on small caps? We focus on small caps because they're way more inefficient than large caps. If you look at FANG, so Facebook, Apple, Amazon, Netflix, Google, every investment bank covers them. Everyone and their mother knows who they are, right? If you look at small caps, most of these companies either were big at once or are brand new or recent IPOs or really just there are a variety of different reasons why they're small or have never grown really. And they're left for dead for the most part, and they're very inefficient because no one knows they even exist. Sort of the business model around looking at small caps is a lot of the investment theses are fairly obvious for the most part, but people just don't know that the company exists because there's something like 10,000 companies that are below $1 billion, something like that. No one can keep track of that many. So that provides an opportunity.
Talk to us about the industries you favor in 2021 and why.
In general, we're generalists, so we look at pretty much everything. We don't do too much in biotech or pre-revenue type companies, but for the most part, as long as we can understand the economics of the business, we're open to it. So because we're so valuation driven and we try to buy things so cheap of current numbers, we learn about the business as we're going. And our margin of safety is that the price is very cheap. Instead of trying to bet directionally on a name or a thematic, we're bottom up. So we focus on fundamentals first, and then we look at trends in the industry.
Give us a market outlook. What trends do you see emerging over the next couple of years?
Sure. So I'm pretty bullish right now. The S&P 500 just broke 4,000. NASDAQ is around 14,000 today, approaching 15,000. The Dow broke 30,000, approaching 35,000. We're bullish. I think that we might see 5,000 on the S&P 500 by the end of this year. It could happen quicker. I don't see a reason why with such low interest rates. A lot of people are talking about the market being expensive, and that is true. I think a lot of names are expensive, but we're still finding value out there. We don't bet on the direction of the market typically, but the direction of the market definitely helps small caps for the most part. So we're bullish. I think that we're going to have a very good year this year in the S&P 500, and I think that'll be good for stocks all around.
Chris, tell us how you determine which stocks to invest in and highlight one of your top picks.
A big part of our process is talking to as many companies as possible. So we try to talk to 50 to 75 companies a week. We try to keep a hand on what's going on in multiple different industries at all times. Many companies we've talked to for years. And we're just getting a little bit of an update of what happened, how their quarterly call went, what a recent press release meant. And that's where it's a different process than looking at larger companies where you don't have as much access to CEOs. So one of our top picks right now, in full disclosure, we are an investor in Civeo, ticker CVEO. What Civeo does is they run remote accommodations in both the Canadian oil sands and the met coal mines in Australia. So in the Bakken or in Texas, you have competition because there are hotels that are right next door or 30 minutes away, or there are communities where a lot of the workers may live that are 30 minutes away. So it's less of a good business. But in the middle of nowhere in Canada or the middle of nowhere in Australia, these businesses are more or less monopolies. And these are very long life projects. For oil sands, many oil sands are 30 to 40-year projects. Met coal mines are sub 20, but still very, very long projects. So during the coronavirus sort of crisis last year, Civio was dragged down with all energy names. I think a lot of you would remember that oil actually went negative. But in reality, oil sands, for example, there's a lot of upfront capex, so a lot of upfront expenses to build an oil sand mine. But over the life of the mine, it's very, very cheap. Think like $20 a barrel to actually extract the oil from the sands. So as long as you have reasonably priced oil, $30 or more, even $20 or more, these mines are not getting shut down. And there was a panic in energy names, and Civio is still extremely cheap because I think there's some overhang on people misunderstand what the business actually does. These are very, very contractually good businesses. And right now, Civio is guiding for $90 to $95 million in EBITDA this year. The market cap of the company is about $225 million. So you can think about it as 2.25 times EBITDA, 2.5 times EBITDA on the market cap. On the enterprise value is about $550 million, which includes debt. We think that over time, the business is probably worth around 10 times EV to EBITDA. But the equity, which is at 2.25 times to 2.5 times, is going to become more of a portion of the actual enterprise value because they're going to be paying off debt. So we think that over the next 3 years, you should have reasonable appreciation in the stock.
Christopher, in closing, where can investors learn more about your firm?
You can find us on Twitter at CHCap2016, and you can find us on our website at chathamharborcapital.com.
Chris, thanks for being with us today.
Thank you. I appreciate the time.